Hey everyone, thank you for coming and listening. I'm sorry that I haven't been around for a while. I think the last video email newsletter I sent out was back in August, the end of August, and I apologize for that. But I didn't want to send out any more information through Blue Sky Financial Flow because I decided that it would be best to rebrand um, what it is that I'm doing and have it more focused. So the new website is bemyownbank.com. So it's all spelled out just like it sounds. BEMYOWN bank.com. Lots of information about what banks are doing and all of that, and how we can become the bank. Certainly over time can be really something. So saving, in this country is at a dismal 3.5%, something like that. And that's a really big problem when people don't have capital that they can invest in things that they can make returns on and all that. um, and and I wanted to become more effective in talking about all this. And so the website needed to reflect that because Blue Sky Financial Flow is a little bit around, all over the place because I have other interests. But I just felt like if I want things to change, I needed to change. And I need to grow in that. So that's another reason why I did it. Uh, and I want to be able to help you look at the website and quickly decide, is this somebody I want to talk to or not? Is this a subject I want to know more about? Do I understand this subject like I think I do? Is my thinking correct? And so you can sort through it much quicker than Blue Sky Financial Flow. It's a little vague. That's putting it politely. But and I just want to say too that you have everything inside of you already to get where you want to go, and to become all that you want to become. So anyway, well, let's get rolling and watch the next video. There's some good information. We're talking about how banks keep us, handcuffed, so to speak. And don't get me wrong, I have good friends that are bankers. It isn't about the bankers, it's about the banking and what it is. It's a tool, right? It's a function. So anyway, there's more educational stuff about all this. And I hope you enjoy it. And please do share it, subscribe, and all that, on the YouTube channel, ding the bell and subscribe. And send me any of your thoughts. I'd love to get your feedback about the new website. That would really be helpful. So if I could ask that you'd do that, that would be great, even if it's just a few words. All right. Thank you. And until next time, take care.
So anyway, today we wanted to discuss what the problem is. If you don't understand the problem or don't sense any problem, the solution doesn't matter. And so we want to try to help you understand and see the problem. And just before we started this, John said, well, actually, there's a lot of problems. But today we're going to focus on what we consider the financial problem within the banking system that we live in. We could also talk about taxes, that money being taken away from us before we even see it, and other fees and all that kind of stuff. But today we're just going to be talking about how banks function and how we live in that system and just think that it's normal, and it is in the sense of the word, but there's a better way for us to be running our financial life. And John, you want to kick it off and start off by explaining a little bit about what we were talking the other day I had called you, as I remember. I had called you because I was trying to be sure about the math on something. And I just wanted to double check. And I guess I also just wanted to talk to you. So uh, anyway, we got into this the thing that I learned from you was that when you had sent me a chart by the Chase Bank, uh, and I think it was August 14th or something like that.
I think it was ninth. It was last Friday.
Yeah, okay. So it was just within this month and this year, obviously. And it showed what Chase was giving for um, savings accounts and checking accounts. Now, what I was questioning was they were saying that they're going to give 0.01% on your checking or your savings. Uh, and I wanted to know what is that exactly? And you said plug in 0.01 and then hit the percentage sign. And I went, yeah, that's what it is. And sure enough, you hit that button. And what was it? It was 0.0001. That's what they give you. And then, so I guess I'll kick it off here and say, as an example, you go into a bank, you give them $1,000. They put, you put it in your checking or your savings. And then a month later, you walk into the bank and say, I'm going to take that $1,000 out and I'm going to go buy whatever it is you're going to buy. And they say, oh, no, no, why don't you take a loan from us? Just leave the $1,000 there and let it accrue that 0.01%. And we'll give you a loan and you'll still have the 1,000 in the savings and we'll give you a loan and you can just pay that off. So you decide to do that and they say, okay, and here it is. We're going to charge you 3% interest. And we were talking, you and I were discussing what the difference is because we've had this conversation before in the sense of they just say they're going to give you, we were using the example of what if they give you 1% on your checking or savings and then they charge you 3%. And the question is, what is the spread or what is the profit or however you want to phrase it that the bank is making? And the spread is 200%. They're making 200% off of you.
I think it's what
You
we
sound a
know
little
people.
far away, John, for some reason,
Oh, really? Do I need to speak up?
or lean
I,
forward.
I don't know. Like this chair doesn't really lean forward, but I'll try to
There
get
you go.
closer.
There, that sounds like it was before.
I
Right
don't
there.
know. Very strange. Okay. Uh, it's trying to really what we were realizing is people don't really think about these numbers. Maybe they do, some do. I shouldn't say. I'm generalizing usually when I say things like, we or us or whatever. But it's easy to say, okay, if I start with $1 this year and next year I have $2, what was my rate of return? Right? Well, we know it's 100%, right? Because we know 100% of one is one, and one plus one is two. So we get that. But when they put something either on your screen, uh, your online account, or you know, you're going and looking at a number on a piece of paper and it says 0.01 and then it has the percentiles sign, we don't realize that the percentile is really just a representation of dividing by 100. You're always right because 1 cent is 1/100th of a dollar, right? So we all understand that it's 1/100, right? And then we understand that if we divide a 1 by 100, it is a decimal, it looks like 0.01. right? Which is 1 cent or 1%. So when you see 0.01%, you don't realize you're actually, you might think you're getting 0.01%, right? But you're really paying what you are, but you're thinking you're getting 0.01, right? You're getting 1 cent for every, but actually you got to divide it. When you see a percent sign, divide the number that's next to the percent sign by 100. And that's how you end up getting that 0.0001, right?
Yeah.
So when I had gone off, Ray, and just said to myself, let's just pick a bank. It could have been Bank of America, and anybody can go do this, right? It's
Right.
easy. All I
Yeah.
did was, say, what is JP Morgan Chase paying for savings and credit? Oh, sorry, savings and checking account right now. And that popped up, and of course the sheet showed that you could have some sort of relationship with them and you could get 0.02. And I
Yeah.
guess what we're trying to get people to realize is, back to your problem, there's a problem where we're being taxed, and it's not just income tax, but we don't have to get into every tax that there is. We're getting taxed by the increase in the supply of money, so that ours becomes worth less. So that's another tax. And because most of us are caught up in this commercial banking world with having these spreads or these deltas between what they're paying us for our money and what they're charging us to borrow their money, right? And that to me is like a kind of a non non-thinking game, right? We think this is the way it goes, and so we don't really think about, we're being taxed because we don't think there's any other, well, we don't even know we're being taxed, but we don't know there's another option. There's
Right.
other options besides using the commercial banking system to borrow. But what I did with you was,
Oh yeah, that was incredible when we did this formula. Is that what you
yeah,
call it?
well, yeah. So I literally said, okay, they're paying me point zero. Well, sorry, clear that. Can you, oh, sorry, you're not seeing what I'm
No,
showing
I'm
yet.
not. Yeah, you're not sharing it yet, but go ahead.
Okay, let me share my screen and just pull up a calculator. And this is
Yeah,
the calculator that's on my computer.
yeah.
But you can pull, people listening or watching, they can pull up their phone. So if you put in 0.01 and then you say percentile, okay, so I'm going to change that. For whatever reason, this calculator is funny. But if I divide that by 100, it should give me that triples. Yeah. Right. So that's really what the rate is, right? That's the truth of what they're charging. But I also looked up, well, what if I was to take out an auto loan with them? And I said, okay, let me clear this. And I see that they're paying, 7.01 2. That was the percent, right? Okay, I don't know why it keeps going back, but I'm going to say it's 7% 02. And this is what it was last week, last Friday. We're recording this on the 16th. So if I said that's the true rate, and let's see if this works, right? I'm going to divide by 0.001. That's 702. That's 702 times. So let's back that up. They're making 702 times. If you put in 1,000 and they paid you 0.01%, and you said, I need $1,000 to help me buy this car, it's a pretty cheap car, but let's say, and I need $1,000, I'm going to borrow, I'm going to pay you just a little over 7%. So it's 702 times, and let's show how that works. So if I went back to that rate of 0.001, which is 1/10 of a percent, right? Uh, and then
Yeah,
I
it's, we,
multiply this times 702. Can you hear me all right?
yeah, I was just going to say, people, please do follow along with a calculator, and maybe with the calculator on your phone, that we have on our phones. We were using that yesterday, and it did work. You plug in 0.01 and then hit the percent sign, and it'll come up 0001. So anyway, I just
But
go
did you
ahead.
see that that came out to the exact same number?
Yeah, yeah.
That's what their spread is. They're making 702 times as much, right? But if I'm saying, uh, if I go back to our 1+1, I have one at the beginning of the year, at the end of the year, I have two, right? I know I've only made one times as much, right? I one times that one was one, and I added to it, and I got two, right?
Oh, that
So
you were
we,
talking about before. Yeah,
yeah, we know that that's the truth. Is they made one times on the money, right? I had one, I made a whole 100%. I made one times that one. I added together, and now I have two, right?
yeah,
So the
yeah.
same thinking goes. I made 100%. That one, I add two zeros to it, and I call it percent. So I've made 100%. Does that make sense?
Yeah,
I've
does
made
to
a
me.
100%. You know that if you had a dollar and you at the end of the year you had $2, what
That's a
was your
100%.
percentage?
Yeah,
That's a
that's a
hundred
100%.
percent.
Yeah,
But I only made one times the amount, right?
right.
I only made one time the one. Same goes for this. Is if I'm saying 702 times,
Right.
then I have to multiply that times 100 because I know that percentile, right? I know that if I say, well, we'll say, sorry, we'll just say 702. It's really seven, it's less than this, but it's slightly less than this. Can do the exact math. But this times 100, they're making 70,200% because I could put a percentile sign by that last zero after the 200. And then if I did, I would just say, well, yeah, I know when it shows percentile, I just divide by 100 to tell me how many times replicated that number. I made 100, I made 702 times as much. There's another way. I'm going to use the example of our friend Todd Langford. He
Oh,
said,
yeah, yeah. Go ahead.
yeah,
The
he said,
1%.
yeah, he said 1%, but we don't even have to throw in percentages. We're just saying we start with one and we end up with four. If somebody had $1, um, I'm sorry, yeah, we'll say percent. You're paying 4% and they're giving you 1% as an interest rate at the bank. So what is the bank making, right? What is the bank making? Well, they're making the difference, right?
Yeah,
Somebody might say, hey, they're making 3% because the difference between 1 and 4 is 3,
yeah,
right?
right.
But we know to get to 4, you really have to multiply times 3. That 1 times 3, because 3 plus 1 is 4. So now you realize that they made 3 times as much. Back to the 3 times, they made 300%. That it's not the difference between the two numbers, the two rates. It's the exponential number that they grow to. And they
Okay.
grew by 300%.
Yeah, that's to go back to your previous statement about you had $1, and then the next year you had $2, you knew that it grew by 100%. It was
Yep.
still only $1, but it was 100%. It was 1 to 1 or 1 to 2, and then it goes
Yep.
1 to 4, and
Yep.
it's so it's 100% on that extra buck you made to end up with 2. And in this case that you're talking about right here, it's 300%. It's the same math. No matter what numbers you're using, it's still the same math, which is what is so mind-blowing about all this, is when you realize the number, the very large number of percentage or times that they're making on our money. And then the question is there a way that you could do this? That you could be the one growing your money? Because so like when you go in and you take that loan for a car, as you said, $1,000, and it's probably not much of a car, but you say, well, I'm going to take a loan for $1,000. They're going to charge me 7%. You're using other people's money, but you're using it outside of a system that you control, outside of a banking system. Is that correct?
Yeah. I mean, to me, it's what infinite banking boils down to, and doesn't always make sense to everybody, but it really boils down to the combination of saving and borrowing, right? So
Yeah.
I want to save and have my money grow uninterrupted, without interruption. And I never use my money. I just let it grow and grow and grow. But when I want to purchase something, I borrow to purchase, and I use other people's money. And of course, people in the real estate business always they many books written with OPM, right? Other people's money. So that's what you're doing with the infinite banking concept, is you're not interrupting your growth because you never borrow your money. Your money stays in the policy to
Yeah.
grow, get dividends, hopefully.
You want to turn off the share right here?
Sure.
Um, yeah. I'm sorry. Go ahead. I'm sorry to interrupt.
No, no. So it's going I'm putting my money into my policy. It's growing uninterrupted through natural growth and hopefully dividend growth, which they've been paying consecutively for over 100 years. We've said this
Yeah.
so many times, right?
Yeah.
And then when I want to purchase something, I leverage my capital and I get a loan from somebody else. So I use somebody else's money. There's another, if you don't mind me sharing again, I'm going
No,
to
no.
share
I
this.
mean, I was just saying toggle back and forth, like like no
Yeah. Okay.
problem.
Yeah,
It's like a
sure.
light switch.
Yeah, I got to use my fingers, just like a light switch.
Yeah.
Um, so another one of our colleagues, Chris Nargle, did a nice presentation and a video. And I love the example because I think it's really simple. He said, okay, my name's Chris. Let's just, we'll call it Ray and John. So you're the banker, Ray, and I'm the person who's got some money in your bank. And I've got 25,000, I think he used. And I've got 25,000 in the bank. And I walk up and I say, hi, Ray, good to see you. I'm here to take out my 25,000. And you say, whoa, what are you taking the 25,000 out for?
Yep.
Okay. So back to, I just said I'm going to take my $25,000 out. And you said, whoa, hey, John, why are you taking $25,000 out? And well, I want to buy this car for my kid and whatever. And you say, wow, well, you're earning 4% here, right? On your 25,000. I'll tell you what, you leave your 25,000 here, paying you 4% for it, and we'll lend you over 5 years. We're going to lend you the 25,000 at 6%.
Sounds
And you
like a
say,
bad
wait,
deal, John.
yeah, say like, well, you're the one giving it to me, Ray. And I'd be like, hey, what the hell, Ray? You're only giving me four, but I'm gonna pay you six.
Yeah, it sounds like a
But
good deal for me.
yeah, it sounds like a good. So if you told me that that's a better deal for you, I might think that you're full of baloney, right? But the fact is, no, you're telling the truth. You're the banker and you're telling the truth. And the truth is, I can show it. I'm going to say this car costs 25,000. You see
Yeah,
my screen?
start sharing again.
All right, let me get down
Turn
here
that
and
switch back
share.
on.
Okay, that's why we're doing this together.
Yeah.
All right, so I'm going to say this car costs 25,000. And I said, you're going to charge me 6%, right? I'm taking
Yeah.
the loan for 60 months.
Yeah.
I'm not going to put in any of these other costs, these fees and sales tax and whatever. And I'm just going to run that. And it says that at 6%, this cost me 20, this car actually cost me 28,000, almost $29,000, right?
Okay.
Then I'm going to move over to a future value calculator, and I'm going to try to move this. I'm going to have to move us. Sorry. Just that I play around with these things all the time. All right. So number of periods means the time frame. So during the same 5 years, and that's what I'm doing is I'm comparing whether I take the money out and I leave the money in. Well, I'm taking the money, I'm borrowing from you, but it's for 5 years that I want to know while I leave that money in there, because you told me to leave it in there and you're paying me 4%. All right. And I'm going to calculate that. Now, let's go back to the auto loan. The auto loan said in 5 years, 60 months, the total cost was going to be 28,999, right?
Yeah.
29,000. But I actually made more. You were right, Ray. You, Ray the banker, was telling the truth. I could be charged. Why is that? I could be charged 6% and only earning four, but I end up with more money.
Yeah.
Well,
Because of the
yeah,
decreasing payments, right? The decreasing loan that and this is appreciating.
exactly. Over here, I'm paying interest 6% at a decreasing number,
Yeah.
on a decreasing number, and I'm getting 4% on an ever increasing number.
Yeah.
So that's really where we need to see that we want to pay ourselves first. We always want to put our money in, and we don't want to interrupt any of the growth. We're just talking about one $25,000 car. Cars can cost 75,000, 50,000,
Yeah.
and you probably buy
Multiple cars over the course of
you,
your life, right?
yeah, yeah. Well, that's a good segue because
Yeah. Into the Brian Bloom's conversation.
yeah, because Brian Bloom says, I mean, uses a $50,000 car for a 50-year-old, right? And he
Okay.
says, we know that, and he used 5%, but it really,
This is the future value one you're in, right?
yep, this is the future value.
Okay.
So he says, okay, um, I could just pay cash for this. I have 50,000, so I go and take 50,000 out of the bank and I give it to the person who's selling me the vehicle. And, you know, I want to know over 5 years at 5%, I can tell you the quick math. That vehicle is gonna now after a year gonna cost you 52,000. I can just do it, right? You just do 1 year and you'll see. It's 52,500. Let's say, typically someone's going to take a loan for 5 years on a $50,000 vehicle. So if I had left that money in there uninterrupted and I was making 5%, right, I'd have 63,814. So that technically says That $50,000 truck or car, or whatever, in 5 years actually wasn't a $50,000 truck. It was a vehicle. It was a almost $64,000 vehicle. But he goes on to say, hey, this 50-year-old, well, let's get to retirement age. Says, what is that going to cost in their retirement? Almost 104,000 is what that, by interrupting that $50,000
How much
cash reserve.
money? Yeah.
Yeah. And then he went out to take that 50-year-old to life expectancy, which is 85, so 35 years later. So to their estate, that one vehicle was almost worth 276,000. Again, back to your point about one vehicle.
Yeah.
It's
Yeah.
only one. And of course, if you're, you know, 50 or you're 40 or, you're going to buy probably more than one car, especially if you live to be 85. Hey, hopefully your $50,000 truck is going to be, still kicking, but you're probably going to go buy another vehicle. I'm not saying you're going to pay 50,000. This is just the point of the fact that when we give away our money, when we interrupt it and give it to somebody else, that money doesn't work for us anymore.
Yeah.
But by the first example of paying 6 but only earning 4, we see that as we have a number that's in our cash reserves or our savings that is continuing to grow, and that is being growth on top of growth, which is the compounding, we can see that we're always going to be growing our money in a much bigger pile of money. And we're going to be paying interest on smaller amounts of money that we're borrowing. So if you could marry the two things, use other people's money to purchase things and save uninterrupted. That's,
It's as
with
simple as
uninterrupted
that.
growth.
It's really
It
as
really
simple
is.
as that. Really is
It
as
really
simple as
is.
that. The other thing about the saving is that you are hopefully you continue to save. Like in this example, you use 5 years to pay for that loan. In those 5 years, you're still putting money into this other alternative, the other option, if you will, that you control, that never gets interrupted, that you're continuing to send money there just like you would if you were saving in a regular bank. And that is also compounding forever. So the number can get even larger.
Yeah.
As you and I know, there are folks that have been at this for a long time, and they're financing all kinds of things like companies and business, investing in companies and all of that. And they're using other people's money to do it and leaving their money alone, just getting
Yeah.
bigger. But
I
anyway,
don't know how this comes off in a video, but I'm going to read the very end of Brian's story on that vehicle that at 85 that took away 270, almost
and
276,000
what's the
from the
title of
estate.
this book?
The title of the book is called Confessions of a CPA, the Capital Equivalent of Life Insurance. And he wrote 3 books with the same title, but he had different subtitles for each of them. And they were all really about life insurance. That's what he's explaining. He still follows the tax code, but he is not a practicing CPA anymore. He used to run pension funds for state universities, some big corporate pension funds. And during that time, he realized how these funds were not really performing the way that they had been sold to people.
Yeah.
And so he became a life insurance agent, and his brother actually became his very first client. That's a side story there, but he's a good guy. I've talked to him a couple times. I think you might have talked to him too. But at the end of this particular book and this story, he says, That is just one vehicle. What if you purchase a new car every 5 years? It says the cost of driving to work where you may be building your retirement nest egg through your 401k, the cost of driving to work, because you needed this vehicle to get to work, could easily be over $1 million. So you and I know, Ray, that most people end up with somewhere around $60,000 in net worth when they retire.
Yeah, that's the
That's the average. We're not talking about rich parts of the country and all that, but it's the average. And so to have $1 million and those people that end up with 60,000, they've worked their whole lives. They've worked
yeah,
40, 50, 60 years, and they really have nothing to show for it because they've been giving their money away
yeah,
because they interrupted their compounding every which way, or they never saved because they lived right up to their means.
right. Yeah,
And that's because, we're bombarded with, hey, this is the next car you should have. This is the way your house should look. This is the stuff you should have. This is, you should travel. You should, I'm not saying we want people to live, really live.
right.
And this is
Have good
not,
lives. Yeah,
yeah, they're not minimizing their lives by implementing this strategy. They're enhancing it.
yeah, yeah. So what we're really trying to show here, number one, is the problem, and the solution really is to actually have your money somewhere where it's growing on a compound basis for the rest of your life, and that you borrow other people's money. And in this case, if you were to do, once you understand what's going on, you'll know what to do. Um, you would, once you understood the mechanics of a whole life dividend paying life insurance policy with a mutual insurance company, you'd probably say, hey, Ray, hey, John, could you help us get this set up correctly so that we could start down this road? Because it's not an overnight sensation in the sense that, you don't make your first annual premium payment and then, it's off to the races. It does take a little bit of time. It can be very short if you wanted to exercise your control over it right away if you want to. But we always like to recommend that you have a strategy for paying back that loan in the early years, certainly. So anyway, I think that's a great explanation the way you talked about it. And the numbers that we were talking about the other day, which I can show these pieces of paper that I had written it all down, and that was one number, was the 119,900%. Can you see that?
Yeah.
And that's just mind-boggling. And I imagine many of us over the course of our lives have the thought, where the heck is all my money going? Well, like we talked about at the very beginning, there's a certain percentage that you just never see in the beginning because of taxes. And then you're putting money into your 401k or whatever it is. And you don't actually get to use that until you're, I think you have to be 59 and a half before you can even touch it. And that's what the rules are right now. Those rules can be changed at any time. And they have been changing. So anyway, I thought that was a great explanation just so you can see. And I would encourage people to pull up one of these calculators. You can actually see what the calculator system was that John, you were using, and they can go play with them themselves. And I also encourage you to grab your phone and pull up the calculator and put in 0.01 and then hit the percent sign so you can see that it's really 0.0001. Um, this is a big problem in my, excuse me, my humble opinion. I wish I had known about it, decades ago. Um, so anyway, anything else you want to say about it?
Well, I'm not ready to end the conversation unless you are, because I think that is a great segue too. Most of my clients, I think, have said to me, I wish I had started this, 10, 20, 30 years ago. And many people call you and say, is it too late? And all that kind of
Yeah,
stuff, right?
right.
Well, it's never too late. And one of the things I say, well, is it too late to put money into your commercial bank? You're still gonna store your cash somewhere. Is it beneficial to start it earlier? Absolutely. If you have grandkids, kids, yeah, of course. If you're 30 years old, it's better than when you're 50. It's just
Yep.
going to be better because you're really going to utilize it for all these purchases in your life. You're going to borrow somebody else's money, the insurance company's money, but you're going to use your cash as collateral in your policy. But you know what? They let that money continue to grow. It's similar to, I think Brian talks about this in his book too, is, when we borrow for a house, most of us borrow because we don't think we can afford it. Most people can't. We don't have 200, 300, $400,000. But when we pay cash, it's because we think we can afford it, right? And when you see that example of the $50,000 vehicle, that 35 years later, it actually took 277,000, almost 277 out of your estate, right? You may live to be 95. And that thing, if it's uninterrupted, is going to keep growing. If it's grown for those 35 years, it's going to keep growing every year. It's going to grow. In fact, it grows every day.
Yeah, right.
But the fact that we think we can afford it when we have cash, we don't respect our own money. We don't respect the value that it serves. We respect the bank's money when they lend us money. We say, yeah, of course we expect to pay interest, right?
Yes, and we
But,
every
but
month too, right?
and if you don't, we've got some, nice things to do.
Yeah,
Take things from you,
yeah,
right? Harass you, whatever. But the fact is that you want to realize that when you think you can afford to pay cash, because almost anytime I talked about money to people, they'll say something about, yeah, well, I just got to either pay this off because I don't want the debt, or I just pay cash for everything, because I just don't like paying interest. Yeah,
yeah.
but you've given up interest. That's what we're showing with that example of the $50,000 vehicle, is that if you took your cash out and didn't let it grow uninterrupted, you self-financed, because that vehicle got more expensive as time went on, because the money it could make on top of the money it made, which is the compounding, that'll never happen.
Yeah.
It's as if it didn't happen. It's kind of like It's a Wonderful Life. If George wasn't alive, right? Well, it was like the money went to heaven. It died. It wasn't there. So to
Yeah.
me, that's what people, I sometimes say the problem is taxes, inflation, interest, right? Interest charges. But the biggest problem is the thinking, is that we're not thinking about this. We're not thinking it through. And what we're showing is what we've learned.
Yeah.
And we've learned through a lifetime. We didn't do everything right. In fact, I'm not saying this is the only thing that ever could be right. But right now, it's much better than the system that we live in, which is giving away our cash and then ended up in a situation where we wonder if we're going to have enough money to live through retirement or our non-working years, or years where maybe we're not capable of working, right? But we still need money. people work way too hard in this, especially, well, I'm most familiar with America. We work, there's 40-hour weeks, there's 50, 60-hour weeks for people. Sometimes people are doing 80 hours a week. Some people end up with money, but even that they could have more. They've given away money too because they've played the system of always borrowing from these other banking organizations. We're saying create your own banking organization.
Right.
And of course, you're going to potentially not be your only customer. In fact, you don't want to be your only customer. Your family might be, your friends, your business
Right. Yeah,
associates.
you want to grow to the point where you have a banking system. Maybe it may be your uh, home base, but then you have all these branches, if you want to call them branches. You have other policies that you're growing, and so people get word that, hey, Johnny Ward has cash that he lends to people. You might want to talk to him, and so that's what you're talking about, right? You're talking about that
Yeah.
kind
Yeah. And it's not like people say. I hear many of my colleagues say, I'm not saying there's anything wrong with the stock market. Well, I'm probably here to say that unless you're somebody really enjoys investing in stocks, just like if you're somebody that really likes investing in horses, then hey, that's great, right? But most Americans, the reason they're investing in the stock market is not because they love all the companies or that they love like working with buying low and selling high and all that, right? They're putting their hard-earned money straight out of their paycheck, either into an IRA or a 401k, and they're just looking for a rate of return. They don't love this. But if they had a capital pool that they were building throughout their lives and opportunities came along, they get to be pretty choosy. They're not desperate, right? They say, I don't need to, you know, go to the casino and hope that I get some rate of return over a long period of time. I can't access the cash, but I'm hoping it's all going to work out that I'll have enough so I can retire at 60 or 65 or whatever. And then I never have to work again. I can travel, spend more time with my family. No, we're saying that wait for those opportunities. The door's always going to be knocked on. I'm sure of it. I work with a lot of guys that are in this real estate business, and they know the people that have cash that are lending cash on their deals so that they can buy a piece of property and fix it up and sell it, or buy a piece of land and buy it low and sell it high. But they borrow the money at pretty high rates. 12 to 15% right now is what people are charging. So, and that's just real estate, but there's all kinds of things that we can, is our dad used to say, ways to turn a buck. um you know I, i've got I got some children that know how to buy stuff low and sell it high, and they've built a knowledge base of doing that kind of stuff with clothing. I mean, whatever you're interested in, do that, right? Because that's something you understand, something, right? Because you're passionate about it, you're interested in it, and you're, and it's probably more fun than just throwing my money into you know kind of a hope and a prayer. And yeah, it might work out. You might end up with 6% before being taxed, so you might end up with 4% over a lifetime, but you didn't have access to any of the cash till after you were 59 and a half. And then who knows what part of the business the government's going to own, because they're going to charge you whatever rate they want at that time. I
of. Yeah,
say stay outside of that. Try to only have cash flow, not income. And this is the way to do it, through this system that you and I practice every day.
yeah, yeah, yeah. Um, all right. The only other one last thing I'll say about, now that's for another time. I was going to talk about the loan, when you take a loan with the insurance company. Well, I might as well just say it. I've said this a number of times, but when you take a loan with the insurance company and you go to pay it back, you send $500 back, for instance, all $500 goes to the principal, doesn't take out any of the interest, but it lowers the amount that the interest is growing on. Unlike your typical loans, amortization tables and all that kind of stuff, where it shows principal and interest that you're paying each month. But this $500, it all knocks it down. So it brings that amount down. So it's even a little bit better.
I love that, right? Because if you sent in 500 and a week later you said, geez, oh shoot, I need that 500.
Yeah.
It's not gone. It's right
Right.
there. You've got access to it again. You can just go grab it again.
Yep. Yep. So
You can't do
anyway,
that with your bank loans. You can't do that with a commercial bank loan. They say,
that's,
sorry, we already got it. And you're like, no, I really need that 500.
yeah, well,
You know?
but that was your payment. You needed to pay that anyway.
Yeah, exactly.
So,
So this is good,
well,
Ray.
yeah,
It's fun.
it was fun. So please do reach out to us. You'll see our contact information in the show notes, and have a great day. And if you have any questions, please do reach out to us. Please do subscribe, hit that bell and subscribe and share if you would. We really want to be able to help as many people as we can, and we can't do it alone. So we ask for your help kindly, and see if we can help some of your friends, some of your family, and all that good stuff. John, this has been fun.
Thanks, Ray. Look forward to hopefully doing it again.
Yeah, yeah.
All right. Thanks for listening, everyone.
All right. Take care.
Bye-bye.